Hi, I welcome you all to this session on mutual funds. So, talking about this particular chapter, this chapter comparatively is very easy and pretty straightforward. The concepts involved are not so complex, and from an exam point of view, the questions asked will be pretty straightforward, and you will be able to score a good mark by attempting the questions on mutual funds. And in this lecture, we are focusing on the basics of mutual funds rather than going into the intricate concepts and the numericals. So let's just discuss what is mutual fund and the types of mutual funds in this session. So although you might be already familiar with what mutual fund is, because it is a very common financial product which is available in the market right now, and most of the people are investing into mutual fund these days, and you are hearing it daily on TV and radio ads. This mutual funds investments are subject to market risk and blah blah blah. But I would like to discuss what a mutual fund is. So there is a general public or the masses, they might not be aware of how to invest in the stock market, or they might not have the time to watch the Indian stock market and decide where to invest, etc, etc. So what they can do is, there are certain mutual fund houses, those are institutions which collect the money from all these investors, from the masses, and they will make a large sum of money or large pool of money, and they will invest this large sum of money into the market, and in turn they will trade the securities, they will make the investments, and they will make some return from that investment in the market, and they will divide this return to the respective investors, okay, in the form of dividends. Okay, that is what happens in case of mutual funds. So let's for your understanding once more, these are the common public or the masses. So they have certain surplus amount of money like savings, so and they don't know how to invest, or they don't have the time to invest by observing the stock market. So they there are mutual fund houses, they will give this money to the mutual fund houses, and these mutual fund houses will invest this into different securities like equity, preference, debentures, bonds, etc. And these securities will give the mutual fund house return, and this return will in turn distributed to the respective investors. That is what happening in case of a mutual fund. So mutual fund house is just an intermediary, okay, but the sum of money this mutual fund house will be investing is like crores of rupees, because they are not collecting from 1 or 2 person, they are collecting from large number of people like the masses. So there is a involvement of public interest also. So obviously these mutual fund houses or mutual funds are regulated by the government, since there is a involvement of public interest. And from a nation's growth point of view also, mutual fund is very good, because it helps in this mobilization of funds from the general public to the market. So that is what's happening in case of mutual fund. So let's put it into words. Okay, so what is a mutual fund? It is a professionally managed pool of funds. So what does it mean? Professionally managed pool of funds. Like the public who may not be knowing how to invest, where to invest, etc. So they will be giving this money to the mutual fund houses, and inside these mutual fund houses there will be like stock market experts. Those people are like fund managers or investment mutual fund managers they are called, and these people will manage this money and they will invest into different securities. Okay, so these are professionals who have the in-depth knowledge of the market. So we can say mutual funds are a pool of funds which is professionally managed. And secondly, like we said, it collects money from many investors. Rather than collecting the money from 1 or 2 persons, it is collecting money from large number of people, means the general public, and they are investing it in the market. So we can say it collects money from many investors and invest in different securities. So it is like a why they are investing in different securities is it is a diversification of risk. Okay, if we concentrate on one particular security, it will increase the risk only. So they will invest in different securities. Like for example, if they are one particular investment, means a part of investment might be in the oil industry and a part of investment might be in the sugar industry. So likewise they will diversify the investments, so the risk will be minimum. And it will give return to these investors. Okay, so this is what a mutual fund is. Okay, the one another thing is diversification. Okay, rather than investing into a particular security or a particular industry, they will be investing in large number of securities or large number of industries, so that the risk of the investors or the risk of the mutual fund will be minimum. Okay, that is another point when it comes to mutual funds. So take a note of this and we can move to returns from a mutual fund. Means what an investor expects or what an investor will get when he invests in mutual fund. Basically, when we invest in shares, what you will get? If we invest in shares, we will get dividend, right? If we invest in debentures or bonds, we will get interest. Likewise, the mutual funds, instead of shares, we will be calling it as units. So the ownership of a company is divided into small units, and such small units are called shares or stocks. Okay, but in case of mutual funds, the ownership is divided into small parts called units. What? Units. Okay, so take a note of that also. In case of mutual fund, instead of shares, we will be calling it as units. Okay, so if an investor is investing in mutual funds, he will be purchasing like 100 units of certain mutual funds or 1000 units of certain mutual funds according to his investment capacity, and he will be getting in return same dividends. What he will be getting? Dividends. Okay, he will be getting dividends, and these dividends are two types: the normal dividend, which the mutual fund declares. Okay, like they will declare like 20 paisa for 1 unit, they will declare dividend. Or sometimes these dividends are called capital gain dividends. So what is capital gain dividends? Let's discuss what is normal dividends. These mutual fund houses will invest in securities like what? Equity, preference, etc. And in turn, this equity, preference, etc. also will be getting dividends, right? And this will be distributed to the real investors, and such a dividend we can call it as normal dividend. Sometimes they will be selling the security. For example, this is a period of timeline, and like at the point t0, the mutual fund house bought a security for 100 rupees, and within 1 year the securities price became like 200 rupees. So there is a gain of 100 rupees. Now when the mutual fund house sells this security, they are making a gain of like 100 rupees, right? And this 100 rupees gets distributed to the investors, and such gain is called capital gain dividends. Okay, so I hope you are clear with this. So the return we are getting from the units of mutual fund is called dividends, and the dividends are again divided into normal dividends and capital gain dividends, or we can say it as capital gain distribution as well. Okay, so that is what return of a mutual fund is. Let me put it in a proper way. Okay, returns are dividends. Okay, instead of shares, we call the investments as units. Okay, and dividends sometimes can be capital gain distributions also. Okay, take a note of this. Now we are going to types of mutual fund. Okay, so we can divide the mutual fund into different types on the basis of different things. Like first will be on the basis of entry and exit. So on the basis of entry and exit, we can divide or we can classify the mutual funds into two types. First one is open-ended mutual funds and second one is closed-ended mutual funds. So what is an open-ended mutual fund? So from the name itself, we can derive that it is open for investment and open for redemption at any point of time. Means at any time I can invest in that mutual fund, I can withdraw from that mutual fund. Okay, that is what an open-ended mutual fund is. At anytime subscription or redemption. Closed-ended mutual fund. But in case of closed-ended mutual fund, we can't do it anytime. Means there will be certain condition, like you can invest at a particular point of time, you can withdraw at a particular point of time. Like they will be saying you can invest at the beginning of the quarter and you can redeem at the end of the quarter. For example, in a year we have like 4 quarters, right? So they will be saying at the beginning of the quarter, if you want to invest, and if you want to redeem, you have to redeem at the end of the quarter. In between, you can't invest or you can't redeem. So that is what a closed-ended mutual fund is. Okay, at redemption or subscription only at a particular point of time. Okay, that is what closed-ended is. Now coming to tax savings. So certain mutual funds will help you get tax reduction under Chapter 6A. But there are certain mutual funds out there which may not help you avail that tax deduction. Okay, the fund which helps you save tax is called tax saver, and the fund which will not help you save tax is known as non-tax saver. So nothing much to discuss in detail. So sometimes you might be having, so mutual fund is mutual fund. Why we are having tax saving for certain funds, and why we are not having tax savings for certain funds? So we, in order to understand that, we have to go into the mutual funds a little bit in depth. So when a mutual fund is constituted, that mutual fund will be having some strategy or objectives. Like they'll be focused on they might be focused on only certain securities. Means it will be non-prior. Means before you investing, you can have a look at the objective of this mutual fund, means what is the kind of mutual fund it is. Some mutual fund will be investing only in equities. Such a mutual fund will be called equity oriented mutual funds, and some may be investing only in debt, means majority of the investment might be in debt, and for the sake of diversification only they might be investing into equity or other securities. So such mutual funds exist, and the governments, according to their policies, they might declare tax savings or deductions for a particular class of mutual funds like equity oriented mutual funds, etc. And in such a case, this investing in equity oriented mutual funds will help the investor to have a tax advantage, while investing in a debt oriented mutual fund might not help the investor to get a tax advantage. That is what a tax saver mutual fund and non tax saver mutual fund is about. Okay, now we have to discuss on the basis of plan how mutual funds are classified. This is very important classification, because in this chapter we will be studying numericals based on this plan, because we will be asked to calculate the returns under each of these plans in this chapter. That is what the numerical questions are about. So we have to discuss in detail how these plans works, or what is the underlying concept behind these plans. So first plan is dividend plan. What is the first plan? Dividend plan. Very simple. This plan will give dividends to the investor. Like I said before, normal dividends as well as capital gain dividends. Okay, if you are subscribing to a mutual fund which is having a dividend plan, such mutual fund house will declare a dividend in a particular time period, and you will be eligible to receive that dividend. And dividend might be normal dividend, or sometimes it will be capital gain dividend. That is what dividend plan is about. And the next one is growth plan. In growth plan, there is no dividend. There is no concept of dividend in growth plan. So why is it so? Then how the investor will get return? What will be his incentive to invest in that mutual funds? So it is simple. Okay, so imagine you are investing like 10,000 rupees. Okay, and by this you are getting like 1,000 units of a mutual funds. It is like shares only, but in mutual funds we are calling it units. Okay, by investing 10,000 you got 1,000 units of a mutual fund. Okay, it might be like UTI mutual fund or Axis mutual fund or anything, and you are getting 1,000 units by investing 10,000. And after like 1 year, means after 1 year, so your investment will become like 20,000. Means the value of market value of these 10,000 units will become 20,000. So you gained here like 10,000 rupees, right? So this is your gain here. So rather than providing dividend, it is growth here. Means you will invest at a smaller amount, and after certain period your investment will grow, and at that point of time you can redeem and get that money out. So that is what happens in case of a growth plan. So there is no concept of dividend here, only growth. So I would like to bring your attention to another point. So when a mutual fund is constituted, initial value of a unit of mutual fund. So when a mutual fund is incorporated for the first time, the value of one mutual fund unit will be always 10. Value of one unit of mutual fund will always be rupees 10 when it is initially incorporated. So when a mutual fund is formed for the first time, the value of 1 unit of a mutual fund will always be 10 rupees. Okay, this is called the NAV, or first NAV, or initial NAV of a mutual fund. Net asset value, we can say it will always be 10 rupees. So please keep that in mind. So that's why in this example we are investing like 10,000 rupees and we got like 1000 units, because NAV was 10. 10,000 divided by 10, we got 1000 units. Okay, now after 1 year, this NAV, it grows like 20 rupees. So 20 into 10,000 units we have, we got, sorry 1000 units we have, we got like 20,000 rupees. And if we sell this 1000 rupees right now, we are getting a gain of 10,000. So that is what is happening in case of a growth plan. I hope you understand this. And one more thing, keep it in mind. Okay, dividend declared will always be on this rupees 10. So if the dividend is being declared as a percentage, we will be calculating the amount of dividend on the basis of this initial NAV of rupees 10, that you may be already aware, because in case of shares also we'll be calculating the dividend based on the face value. Okay, the initial value, that is what applies here also. If the mutual fund house is declaring a dividend of like 20%, we'll be calculating the 20% on the basis of 10 rupees. That is 10 rupees into 20% will be your dividend amount, and it is per unit value. Okay, so now coming to the third plan. So we have discussed about the dividend plan here, then we discussed about the growth plan here, and now coming to the dividend reinvestment plan. So what is this dividend reinvestment plan? In this case, we were distributing this dividend to the investors. Okay, as and when the dividend is received by the mutual fund house, they will distribute to the investor. But in case of dividend reinvestment plan, the dividend earned by the mutual fund is not given to the investor. Rather, the dividend amount will be reinvested. What happens? Dividend amount will be reinvested. Let me explain this to you. For example, there's a person called Mr. A. Mr. A had like 10,000 rupees. He went to a mutual fund and he invested that 10,000 rupees and he got like 1000 units. Okay, and after 1 year, this is the initial NAV here was like 10 rupees. Okay, and after 1 year the NAV rose to like 20 rupees, and the dividend earned by the mutual fund house is like 1000 rupees. Now ideally, if it was a dividend plan, this dividend of 1000 rupees will be given to the investor. But in case of dividend reinvestment plan, what the mutual fund house will do is it will convert this dividend into units and it will keep it in the investor's portfolio. Like the 1000 rupees is here. So what is the current NAV? It is like 20 rupees and it will give 50 additional units to the investors. So the total number of units held by the investor will become 1000 plus 50, 1050 units. So this will become the investment of the, means new holding of the investor. So rather than giving the dividend away, it is reinvesting that dividend at the NAV prevailing at that date. That is what is called dividend reinvestment plan. Okay, so it won't give the dividend amount to the investor, rather it will invest that amount into the fund again by issuing new units. Okay, this is what dividend reinvestment plan is. Now one more plan, and it will put an end to this lecture. Our last plan is bonus plan. In this plan also there is no dividend. So there is no dividend, there is no concept of reinvestment also. Rather, this plan will give the investor a certain number of units, okay, at a particular point of time. Like for example, a person had 1000 units of mutual fund, and after 1 year the mutual fund house will declare, like, on the basis of ratio like 5:4, we will give you additional bonus shares. At means free of cost, they will be not shares, bonus units. At the free of cost, the investor will be getting some more units. Okay, so this will enhance his holdings on the mutual funds. So rather than giving dividends, or rather than reinvesting the dividends, just the mutual fund is giving certain additional number of units on the basis of certain ratio. Okay, so that is called bonus plan. So these are the 4 plans. Dividend plan, it means we will be giving, so the mutual fund will be giving a dividend. Sometimes it is normal dividend, sometimes it is capital gain dividend. And under growth plan, there is no concept of dividend, rather the value of the mutual fund, or value of per unit mutual fund, will be going up, and the investor can redeem that by selling those units at a later point of time. Gets a dividend reinvestment plan. The mutual fund earns the dividend, but rather than distributing that dividend, it will reinvestment that dividend at the current, or at that NAV prevailing at that date, and convert it into units, and it will increase the investment or holding of the investor there. And the last one is the bonus plan. Under this, there is no dividend concept, rather the mutual fund house will issue certain extra units or bonus units to the investor, and that will be at free of cost, because bonus means it is free of cost. Okay, so these are the basics of mutual funds, and from the next lecture onwards we can go into the numericals and a little bit more concepts. Okay, thank you.